One of the areas of the market that is well tracked is housing. Whether you're an investor of REITs or attempting to buy or sell a property, you probably have a lot of questions. Like, where will the rates be heading this year? Will house prices rise or fall? And what does overall inventory look like right now? We're going to answer those questions and a whole lot more right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you again for joining us. My guests today are Nadia Lovell and John Woloshin. So, John, let me start with you because many of us know the last couple of years have been very tough for those looking to buy a home. Obviously, we see high mortgage rates and inventory has been an issue. So we're now right at the precipice of spring selling season, which gets a lot of people out of the house to start house hunting, maybe even putting houses on the markets. But I want to ask you, let's look at the dynamics, right? What's been going on for the last year, and what do you expect for the year ahead?
Yeah, so I think the biggest issue that's been going on is obviously the elevated level of interest rates and the attendant impact on affordability. Now, the logical question that would follow is if affordability is as challenged as it is, how is it that home prices have remained elevated? And I think really what it comes down to is a lack of inventory in the existing home market, which accounts for the majority of the housing market, somewhere between 85 and 90% in terms of sales. But the other thing is the home builders have a real advantage here, and that is really twofold. Number one, they have the land and the ability to build homes. But number two, because they have done such a great job of managing their balance sheets post the global financial crisis, they have the ability to what's called buy down the mortgage rate. Basically, what they're doing is, particularly the larger home builders, are going out and buying forward bulk mortgages at much lower rates, and they're able to pass these savings on to home buyers. So, look, the important thing to remember is most home buyers buy on payment and not price. So, if a home builder says, "I can get you into this house," at a price at a monthly payment that is say 10% below what they thought, that in a lot of cases will make a big difference for people. As far as our outlook for 2024 in terms of home prices, barring either a major recession, which is certainly not the house view call, or a significant change in interest rates, and our house view call is for a somewhat of a pullback in rates. We think at the margin that will certainly help affordability. And if rates do come down, we think that will open up some of the existing home market to maybe some new inventory. But in terms of home prices, we think on a national basis, plus or minus 5% either way.
Great, John. That's a great way to start us off. So, Nadia, the question then comes into the mortgage rates themselves. We had mortgage rates hitting a high of just about 8% last October. Now they're sitting at about 7.25 or so. Could buyers get some relief this year? John mentioned the house view is that we are in for a soft landing, no big recession. But what does that mean for rates and affordability for buyers there?
Yeah, so we think that rates will move lower this year. We think that by the time we get to the middle of the year, that the Fed should be in a position to cut interest rates. We're looking for 75 basis points of cut this year. And so as that happens, you should be able to see the yield on the 10-year Treasury to move lower and towards 3.5% by the end of the year. Right now, today, when we look at that, with the spread between the 10-year Treasury note and the 30-year mortgage, it's about 280 basis points, which, Anthony, that is quite high. Historically, that spread is usually 175 basis points. So we think that that spread will compress just a bit to 200 basis points as volatility eases. We've seen elevated volatility within the rates market. It's starting to normalize. We expect it to come down further. So all that said and done, by the end of the year, we think that the rate on the 30-year mortgage will likely be between 5.5% to 6%. So that should help improve housing affordability, potentially cause some turnover in the housing market. And even on the margin, we could see a pickup in refinancing activity. Now, today, over 90% of outstanding mortgages were underwritten at under the 6%, so it hasn't been attractive to refinance. So we think overall lower rates should help a pickup in housing activity.
Great. And then, Nadia, let me stay with you for a second because we're looking also at home improvement spending. More people are staying in their homes. Certainly that was the case during the pandemic. And, they're trying to get the best price for their property. But it's grown a little bit weaker recently, the home improvement move over the last year or so. How do you see that market playing out here as rates start to decline?
Absolutely. Not only are people staying in their house a little bit longer, those houses are old, Anthony, as well. I mean, the median age of the housing stock is about 40 years. And we know those older homes, they tend to need a little bit TLC, a little bit repair and remodeling. And as you noted, like during the pandemic, we did see a surge in spending as we were all at home. We saw about a 20% or so jump in home improvement spending. Since then, it's been somewhat anemic, but we do think that will start to bottom up this year. We think that in the back half of the year, we should see a pickup in home improvement spending. We've been hearing from some of the home improvement retailers that customers have been delaying, canceling, or downsizing projects. Some of this also has to do with inflation. Inflation has been quite elevated, we know, over the last couple of years, particularly within building materials. And so as that comes down, that should probably help as well. Also, with home prices going up, as you heard John talked about, the homeowners are now sitting on a lot of dry powder. In fact, home equity in the U.S. is at a record level, about $33 trillion in home equity. But higher rates have made that equity a little bit more difficult and expensive to access. As rates come down, that might entice homeowners to access that equity and potentially see a pickup in larger home improvement projects. So we think overall in the back half of the year, we'll expect to see some improvements.
Great. At $33 trillion, that's more than the entire U.S. economy, the GDP of around $30 trillion. That's a big number.
Yes, exactly.
All right. Thanks, Nadia. John, I want to kind of end it with you here. And given where we're talking about rates going, given the, the affordability right now that's happening in housing, where are the investment opportunities today?
Yeah, so a couple things. The home builders have certainly had a very, very strong run over the last kind of 15 months. Now, while their valuations, depending on how one measures valuations, are certainly not what they were, I wouldn't call them screamingly expensive. I just think the risk reward is maybe getting a little less attractive. So while we still think, especially if rates do come down, that there could be some upside, we would just, want to manage expectations for not seeing the same type of move in the builders that we've seen up to now. But the other thing is, if rates come down, as we've talked about, and it does open up the existing home market, we have to remember that when people buy a house, there's a lot of spending that goes with that. You mentioned earlier about some of the home improvement retailers. Well, when people buy a home, they typically will buy new furniture. They will likely do some repair projects. They will likely change fixtures in bathrooms and in kitchens. So we think that there's a number of ways people can play it. We also think the new home market will continue to do fairly well. And again, a lot of it comes down to the ability to home builders to deliver product in a fairly expeditious manner. We're seeing cycle times, or the time it takes to build a house, come down, and they do offer a plethora of options. So that will be another source of demand there.
Great, John. Thank you very much. So great opportunities there. And, obviously we're going to keep our eyes on the spring selling and buying season and get you back in for another conversation. Good to see you, John Wollaston and Nadia. Great to have you here in the studio. Thank you both. And for more information, you can visit our Insights website at ubs.com/views. Plus, you can follow us on social media. We're all over the place: LinkedIn, Facebook, Instagram, and Twitter. You can specifically follow us here in the studio on Instagram at UBS Trending. And please, as we always encourage you, continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.